I think Emily's organization, Credit Karma, part of Intuit, is remarkable in that you've successfully engaged over 140 million of these folks. I've been working in the financial services industry for decades now, and it's pretty easy to follow the boomers who have 60% of the assets, and you're never going to go wrong just retreating to higher and higher net worth. I mean, I think some organizations sub-segment ultra high net worth eight ways, and it makes sense. But at the end of the day, we're going to have to ultimately deal with this generation, and Emily is at the vanguard. So
All
I'd
right.
like to start with just an introduction because there's a great story here. Unlike, say, J.P. Morgan, 200 and some odd year old brand who grew up with our great grandfathers, you were born later.
Yeah.
Why don't you just tell us a little bit about Credit Karma and how you were born and how you landed with Gen Y or Millennials?
Sure. Well, I'll start with me. Hello, I'm Emily Childers. I lead growth marketing at Credit Karma. I've been at Karma for about 8 years. I've jumped around a little bit. I led credit cards marketing as the head of cards marketing for about 5 years. I was the general manager of personal loans for about 2 years. And now I'm back in marketing, leading our growth marketing organization. So Credit Karma has a really interesting story. So we're about 15 years old. We were founded about exactly when I graduated college. So I was the target audience. Credit Karma is really interesting because we were truly first to market with a free credit score. Who gets that kind of market advantage? It was incredible. So we went live to market with an actually free credit score, no credit card required to see your credit score. On the coattails of Experience, freecreditreport.com, which required, you guessed it, a credit card. It wasn't actually free. It was a free trial, and then you paid a monthly fee to get your card. So they were spending millions of dollars in marketing, freecreditreport.com, with these really catchy jingles. I don't know if y'all remember it. And we just slipped right into the market onto their coattails with truly free. And so we were solving an actual consumer problem. We were the first to market, huge moat. So that was a really fun exercise. And how do we meet our target audience where they are? That's the marketing problem, right? Our target audience was anyone over 18, specifically folks who were new to finances, graduating college. So my personal Credit Karma origin story is like actually pretty reflective of the general experience. So I had graduated college. I was a few years into my career, making not very much money, and I was applying for an apartment. So I went and saw the apartment. It was in Santa Barbara. Tons of people were seeing this apartment because it was beautiful. It was walking distance to downtown. It had bougainvillea around the patio. It was a dream. And I was prepared because before going to see this apartment, I had went and searched what are the best ways to get an apartment and like be top of the stack. Well, show up with your credit report. I don't want to spend money for that. So I went down search results looking for what was actually free. Credit Karma was actually free. They were showing up in paid search. I had seen their brand on TV. I trusted Credit Karma. So I signed up, logged in, printed out my free credit score, brought it with me, and I got the apartment. Like this, I was not the only one. This was a common problem. It was a brand that was solving my actual need in that moment. They made my life better. I got the apartment of my dreams. I lived there for like 5 years. It was awesome. So it was really fabulous of going to market with this product that solved a real problem. So it was an easy marketing problem. And a surprise of how we went live in market and scaled. How we gained that first 10, 20, 30 million members was linear TV. It's crazy, right? Who goes off to the races on linear TV? But that's because that's where folks were then. There was no OTT. Netflix was founded, right, in 2007? I think it was around the same time. Like, there was no OTT. Digital tracking was not amazing. Paid search was there, but we went live with linear because we could get cheap CPMs with a true solution to a problem. And we watched our dashboard spike. We would run an ad in late night TV on Maury Povich or whoever it was. We'd watch the acquisition spike. So we met our target audience where they were with a message telling them exactly how we could make their life better. So it's been a really cool story. And like, I am one of the folks that was in that first tranche of members. I was an early adopter. And since I've been at Credit Karma, our problems have shifted. We obviously have grown up. We're a teenager. We're 15 years old. Those millennials that were early in their career are now a little bit more established. We're no longer, getting started in our finances. We are planning for the future. We're making a bit more money. We're not Henrys. We're not high earners, not rich yet. We're like further along on our way. We're further on that journey. We have not done an amazing job of shifting down. This is our problem today. How do we go get Gen Z?
Wow. So what we're going to talk about today is changing our media, our channels, our content, our message, our value prop, and to some degree our offerings.
Yeah.
Because, and so just for context, Emily and I published a case study on Forbes with a wonderful thing. I have to do a lot of homework here. Does everybody know what a millennial or a Gen Z is? I just want to get out. There are 142 million of that. 72 million are Gen Y or millennials, which you do well with. Another 69 million are Z. That's more than Uber's X combined. They're 59% of the workforce. So if you're like, TIAA who's talking tomorrow or an asset fund that's sitting inside a 401k program, your brand is being exposed to these people. Boomers, by comparison, are only 6% of the workforce, which means I should be hanging up. They do control only 11% of the assets, so obviously the boomers have 60% of the assets. The elephant in the room is $84 trillion of assets are going to change hands from old people who understand who some of these wealth brands are to younger people who could care less. And that's what I call it, the great wealth transfer. So I think that's why we should care. But these guys are different. Our research says 60% are actively considering investments, insurance, banking, mortgages. So they're in market. They think differently about trust. They value honesty and transparency on a level that maybe our compliance departments won't let us communicate. They've got different views on personalization and privacy and the trade-offs between those two things. They think differently about brand. You may not have any brand equity with these people. One thing I really think is interesting about what you do is you've got a teachable moment where they're ready to learn about finances and they're getting serious. They're not what you call Henrys, but they're forming a brand impression. Whoever teaches them about finance or life insurance or investments, probably going to get inserted into their brain. And what I thought was interesting is they like different asset classes. No surprise, they like crypto. They also like art. They're more prone to invest in art, collectibles, and digital assets. MasterCard is having enormous success in an era of points inflation. Instead of giving away hotels and flights, they're giving away tokens inside video games, and they're crushing it with this generation. They think this is the greatest thing in the world. So that's the background. It was education for me, maybe not an education for you, but against that background, looking at media, content, value, and offerings, can you explain how everyone here can win with millennials?
Oh, yeah. So I'll start with millennials and then we can dive into Gen Z, which is really interesting. Just a fun note that you were talking about, they don't know or care or trust big brands. That's actually kind of core to that demographic. We were doing some member research recently and we were talking to somebody in our navigating opportunity segment. This is our higher earning, higher net worth members. And she was talking, she's a winery owner, she's young, she's super successful. And she was talking about her investment strategy. And it was fascinating. Not a single big brand came up. She was like, my friends told me about Ellevest. And I was like, what is Ellevest? This is a investing platform built by women for women. It's a small little startup, but it was network effects. It was community. It was influencers that got this product in her hands. Yeah. Yeah, it's a completely different marketing paradigm that you're not going after traditional media to show up as a big trustworthy brand. You need to get in at the bottom as an authentic voice through their network. It's fascinating. But okay, dialing us back, what I'm supposed to be talking about. Millennials in general are really interesting. So I talked about getting into the market with linear TV, which is honestly unusual. And it's because we were so differentiated. The next step was paid search, right? Go where people are. Millennials are still searching on Google. They were still searching on Google then, they still are today. I still go to Google. I have not fully adopted, well, maybe some of my peers have, but I haven't fully adopted going to an LLM as a search platform. I don't do my searching on TikTok usually, but a younger audience does. So Google search, traditional search channels, that is where millennials are showing up. So you have to be present. I talked about this in the prior session, that is pure intent, right? You're capturing pure intent when you go to paid search. You are saying, oh, you have a problem? I can solve your problem. It's great. Next for us was layering an email. There's an interesting correlation. The older you are in our member base, the more likely you are to click on my emails. So boomers, they're great. Yeah, I mean, y'all really engage with my emails. Thank you. You open and click them all. I love it. So that means we're going to send you more. And the millennials too. We still manage our inbox. Email is a primary place for us to go get our information, to check in. We trust what comes into our inbox. So email is a really key channel for us because after a member joins Credit Karma, sees their first free credit score, we want them coming back. We don't monetize until we're able to capture their intent to take out a financial product. So only about 15% of our monthly active users will convert in a month on a financial product. This makes sense. If you were to log into Credit Karma every month for a year, you're not taking out a credit card every month. That would be crazy. Please do, but that would be crazy. So email was the next layer in. How do we think about this engagement funnel? How do we make sure that our acquired members are coming back, logging in? So that was a really key thing to layer in for us. And now we're seeing with a younger demographic, they click less. They don't manage their inbox. They're not into it. Push is a really interesting addition. App marketing in general, for a younger audience, they're more likely to engage with push notifications than they are email. Quick, pithy, check a thing. There's a lot more appetite for it. So we've had to shift our owned channel mix from email only to email plus push. And it recently hit that precipice of about half of our logins were coming from email and half were from push from an owned enticed perspective. Obviously, we have organic as well. That has now shifted over. We have majority enticed traffic coming from push notifications. It's a really interesting shift. So we've had to be really dynamic to change our channel mix as our audience has shifted. And then with millennials as well, it's clear we want to be told a problem solution with a wink and a nod. I don't know. We've tried some weird marketing in our offline. I don't know if anyone remembers I call it the brown period of Credit Karma, where we had literally a person dressed as gum being digested in our ad. We had a guy whose fingernails wouldn't stop growing. They didn't really perform. I'll go out there and say the weird stuff didn't actually perform for us. Didn't engage. Our millennial audience didn't respond to it. They're like, "What are you doing?" You look at viral social marketing today. That stuff is weird. I actually love this. Gen Z is a little unhinged. Anyone else following the Nutter Butter saga? Dude, it's so cool. If you haven't read about this marketing case study for Nutter Butter, it is incredible. Aiden, I think is his name. Yeah, now this guy who it's super weird. Too far beyond for me to really get it, but they've gotten massive impression and mind share from this crazy pants viral marketing scheme. So there's an authenticity component as well to age and how do you speak to your audience. And I would actually go as far to say boomers, they love dad jokes. The more puns I put in email, the more they clicked. I did some analysis back in the day on my email portfolio. And I was like, oh, what's resonant? Do jokes work? And the older you were, even beyond that correlation on clicks, the more there were puns and jokes, the more older demographics clicked. And then the younger you were, the more likely you were to engage with congratulatory kind of weird statements. We did a lot of woos and wees. If you're opted into Credit Karma email, you know what I'm talking about. But really, it's figuring out the channel and the voice, the tone of your creative that will resonate with an audience. And you do all of this through testing. You need to be testing and measuring everything and sub-segmenting to look for where it's working.
So and again, just to define, I gotta do my math here. Can you define the age break, or do you want me to do it?
Ooh, if you could, I don't know. I know I'm an elder millennial. That's all I know.
Age break, as I understand it, millennials, where you get A plus, from 1981 to 1996, Generation Z, 69.3 million of that with trillion in assets for the workforce is 1997 to 2012.
Yeah.
And so they are just, my daughter, just getting her first credit
Mm-hmm.
card. Getting, my son works for JP Morgan Chase, and you could not get a JP Morgan Chase credit card. You know,
Yeah.
so and it's 23. So, I get it, but just to clarify, 1997 to 2012. This is new territory. This is new territory. Tell me some of the stumbling blocks. You don't give yourself an A plus.
No, I think you wrote down in some of our prep notes, you're like, give yourself a B minus. Do I give myself a B minus? I'm like a C student on this one. Um, it's not just the age demographic that's been an interesting shift for Credit Karma. It's also the market changes. So when we went live with Millennials, we were winning because we were first and we were only. Oh my God, what a marketer's dream. I wish I worked for Credit Karma back then. It's such a delight. Now, credit scores are truly commoditized. You can get them everywhere. Every financial institution is going to give you your credit score for free. It is table stakes, right? Folks are giving FICO. We don't actually show FICO because it's pretty expensive. We do pull FICO for approval odds in our marketplaces, but we don't show it to consumers. So we no longer have the competitive edge we used to. So we've had to not only change our audience approach and target to a younger audience that has a totally different perspective to media, we've also had to change our value prop approach because we can't say get your free credit score will change your life. Because who would believe that? Everyone's going to give me my free credit score. What are you talking about, Credit Karma? So we've had to move beyond that. So we've expanded our product offerings. So we've moved into really the financial marketplace space where I think we are truly winning, where you can see financial products that you will be approved for or most likely to be approved for without having to do anything. No impact to your score, no pre-qual, great transparency. So we've really differentiated in that space and that's worked. This is very bottom of funnel direct response category marketing though. At the brand level, we're still struggling. So the reason I think I'm a C student for Gen Z specifically, like I'm very data driven, is one, the math. We recently looked at our reach and frequency by key segments, and we're 14 points below index for reach, and even worse on frequency for an 18 to 24 audience. And that for us is kind of the Gen Z, parallel. We call it getting started. So I'm underpenetrated in my media. Why? Well, because I'm running my media like I'm only targeting millennials. Why? Because millennials convert at a higher rate because we speak to them the way they want to be spoken to. Great. How am I going to go change this? First step, I have to go figure out how to speak to a younger audience. I have to talk about the products that will help them. I have to adjust my creative and my brand positioning. Great. Now that I've done that too, I have to change my media buying strategy. So we're reinvesting in social, despite it not performing as well on our core metrics as other networks and channels. Because if you think about it, if you have a lower credit score, you're less likely to be able to take out a wonderful, high value travel rewards card that has a higher monetization and impact to us. You're going to have a starter credit card, which is still great, but we want to bring you in. We have to think about how we set our optimization function a little bit differently to reach this audience. So we're in the middle of a kind of a brand shift to targeting that full funnel instead of just the bottom in direct response and category, and shifting up to brand, investing in social, hiring more Gen Z, candidly. Because again, I'm a millennial. I know how to talk to people like me. I know what resonates. My creative team, they're around my age, we're peers. We've started being more purposeful in the teams we hire. Because the best way to be authentic is to have representation of the folks you're trying to talk to on the team, building the content. Because you can do all the research you want. But then whatever you put together might be called cringe by Gen Z. Or wait, I take that back. I think cringe is cringe now. I don't know if anyone young in the audience can tell me. I think that's a millennial thing to say. Shoot. This is the thing. You need them in the room. So if you're trying to reach a new demographic and your whole team, there's not a single representation of that demographic on your team, you have hiring work to do. It matters, right? I gave that Nutter Butter example. They hired a young youthful agency. They got the guy who was doing these weird comments to come in and work on their team. That is the definition of authentic. They brought the folks in. So for us, it's media buying strategy. We have to take a different approach to measurement. One of the things we're thinking about is extending out our payback window. So when we acquire new members, folks in performance marketing, you're looking at a lifetime value when you acquire a member, right? Like an LTV. You can do 3 months, 6 months, 1 year. We're extending that payback window with the expectation that a younger audience will stick around for longer and be valuable. It's a logical extension. But if we hadn't looked at the data and said we're underpenetrated, why? We wouldn't be making that shift. And then, creative media buying strategy team. Get the right team in that can speak to the audience.
Full disclosure, that demographic, hiring the right people. My daughter, who is at college, she's 19 years old, asked me to read this disclaimer. Do not listen to anything I say. I am culturally irrelevant, anachronistic, and I know nothing about what anybody under the age of 23 is feeling or thinking. So with that disclaimer, back to you. And I want
I know you can put it on me too.
shout out to Anna. That said, you've been forced to experiment with, you got some really interesting insights on what AI is doing to search. You also talked about building trust. Endorsements are difficult and risky. You talked about the places they're going from advice. Rather than go to search, they're going to different places. Can you dig in on what's happening to search, how you think about partnering and affiliates and things like that at a granular level? Because you had some really scary stories, at least that scared me.
I mean, that's my hot take, is that Google search is dying. Slowly, but it's dying. From a user perspective, I don't know if anyone in Google's in the room. It is not great. I know your brother worked there. He led that platform, right? The user experience today is not
He's a
amazing.
boomer, by the way. I don't listen to him.
That's fair. That's fair. It's not a great user experience. It's no longer organic placements. SEO as a play on Google is shrinking year on year. You look at earnings for NerdWallet. You look at earnings for anyone who's SEO dependent. They're having a really hard time. There's a couple reasons. One is they have dominated the surface with paid ads. So paid search is still there because people are still going to it, but I think the consumer experience is being eroded. So we're slowly going to start seeing traffic move to other places. You're seeing Google try and pick up on some of the trends that are actually happening. So I talked about this trust and authenticity with Gen Z. They don't trust big brands nearly as much as they trust their peer network, influencers, UGC, user-generated content. So what Google has done is now they are up leveling and like taking snippets from Reddit. It's like a Reddit summary in half of the searches that you go and look at, which sometimes is great, sometimes is not, because it's Reddit. It tells you to do things like put glue on your pizza to keep the cheese from sliding off. Like, it is not a trustworthy source. I mean, that was a joke, but AI did pull that as a recommendation. I think it was Microsoft, maybe.
No, but it's funny.
Yeah.
She told me this stuff, and all of a sudden I started noticing it. It's like, wow.
Yeah, it's a total shift. So we've already seen SEO shrink. SEM is still doing fine because people are still going, but I personally, this is again my hot take, I think it's going to be eroded by upstarts in the industry. I think some of the LLM search platforms are interesting. I have no idea how to market on those yet. And then you actually see this behavior with Gen Z. They're going to TikTok to search. Like, sure, recipes make sense, but they're actually going for things like financial advice. They are trusting TikTok influencers over the big banks. So how do you get your big bank into the story? Well, you work with influencers, right? You make sure that you're working with high quality influencers who have that trust and arm them with the correct information to bring in qualified traffic. We have not cracked TikTok. Again, I'm a C student here, but it's a space that we're seeing grow. Instagram, millennials, we're using that as a TikTok proxy because it's slightly less addictive and a little less scary. People are going there to search. This is what my friends are sending each other. We're not sending each other Google search links.
Another thing that made me fall out of my rocking chair was this notion of misinformation, where they are learning. And that scares me because honestly, I think financial literacy is the killer app. And I think if I was in your shoes, I'd be partnering with you. I think that's the way to go. But it scares me now that I look what people are learning on the street and how little they know about financial discipline. They're not even teaching home ec anymore. But talk a little bit about misinformation and how that's the enemy of all of us.
Oh my gosh, it totally is. Well, it's always been a problem. So this is the thing. This is not a new problem for the folks in this room. Just before we couldn't see it and it wasn't amplified. So you think about bad advice with your finances. Usually it came from your uncle at Thanksgiving or your friend at brunch, right? Bad advice is pervasive. Misinformation is pervasive. But now you see it being amplified on digital platforms. It's interesting. One of the things that correlates with a child's future success is the financial stability and success of the adults in their local network, their friends' parents, not just their parents, but their friends' parents, because it is those parents teaching the children the financial tools and infrastructure to go manage their life. You learn your finances from the network you grow up in. So misinformation has always been prevalent, and if you are in a lower income area, there's probably more misinformation. It's probably not the best advice. Whereas if you're growing up in a wealthy area and folks know how to invest, they know how the system works, you're going to get pretty good information. Today, we have the ability to democratize that information a little bit more. That is Credit Karma's mission. We're trying to take these black box confusing systems, candidly, that were designed that way on purpose because it helps maximize profit, and make them transparent. Help every consumer figure out the way systems work. Like, it is not in anyone's best interest that when you apply for a credit card, one, you don't know if you'll be approved, and two, you have no idea how big that credit limit's going to be. That's bananas to me. You don't apply for a loan and say, I'd like a loan. They say, oh, you're approved. Wait, how much did you want again? Like, no, you need to know how much you're going to be borrowing. Like, you know what your need is. You know how much money you need. So we're trying to bring transparency to all of these components. And that's even just on the system. On the financial education and misinformation, it's always been pervasive. But now we need to also mitigate the amplification of that misinformation on social networks and through UGC. It's hard. It's like you see things like LinkedIn being really successful with vertical video. There is not much, like there's not a huge cost from giving bad job advice, bad career advice, right? Like you can go in there, record a video, and it's like the advice isn't perfect, but like it's not going to really hurt anybody.
Mhm.
If I were to do that on a social platform about finances, that has real harm. So it's going to be an interesting few years. This is an area Credit Karma is thinking about investing in. How do we bring that education? How do we show up in more places? And how do we battle misinformation? But again, C student, don't have an answer yet.
Yet another story you told me that scared me is when we pick, for our clients, we'll pick influencers, people who are talking about this, and rationality says who's got the biggest audience, who's got the biggest reach.
Yes.
But the people who have the biggest audience or the big viral spikes are the ones who are on the crazy polls.
Yes.
They're saying crazy stuff to get that. And sometimes you want somebody who's boring and in the middle, but align with your brand. So I get super scared. Given our wind down in time, given the mix of brands and offerings in the room here, can you talk a little bit before our questions about the need to redefine what financial services means? That was something you told me that I thought was pretty interesting because I think everybody could get something from that.
Oh, I don't even remember what this prompt was.
Well, I guess at the end of the day,
a lot of stuff.
Yeah, I guess you're saying buy now, pay later. That is something that younger people do that maybe we used to call it something else. But I guess, was just a story you told that resonated with me. We are short on time. Emily is an incredibly interesting person who will be here. You're here all week. Any questions that maybe you could tap into her expertise?
Hi, I'm Molly, and I oversee organic social for a digital marketing agency that works with credit unions and banks. And we also do paid OTT, all of that. But earlier today, not in this session, but a previous one, you mentioned that a big problem is trying to reach too many people, that you're trying to reach everyone. And that's really challenging. And I think that's something that a lot of financial institutions are facing. You gave one tip that I thought was helpful, focus on email and push, because that can reach both of those audiences. Are there any other tactics that you're using to hit both millennial, Gen Z, and still keeping the boomers happy, because I know that's an important segmentation for a lot of the financial institutions.
Yeah, absolutely. And it's interesting. These strategies are not a like one-to-one targeting. Like I'm not saying I'm going after just millennials here, just Gen Z here, because that's one, more expensive because you're limiting your reach and your audience. It'll be more expensive on the CPM basis. And then two, you're often missing those blurry edges because there is no hard cut line in segmentation. I would love for it all to be MECE, mutually exclusive. It's not. It's like it's a distribution. So the way I think about things is like email. Great. Our distribution is a little bit older on email, but it actually overlaps beautifully. Like there's a big overlap with push. So we're sending both to both, but you're going to try and sub-segment the content within based on affinity, based on demographic, based on whatever your sub-segmentation framework is. For us, a big piece is credit score because that dictates, one, what you should do next. Are you trying to build your credit? Do you have great credit? You're trying to get a product. Do you have a lot of debt you need to consolidate? So we're sub-segmenting into need states versus like age demographic. So the age is more of an overlay to understand in aggregate who are we talking to. Yeah, and then the law of averages is like, look, if you can make a broadly targeted audience strategy work, that is amazing. That was our strategy to start. It was like, wow, things are going great. And we would optimize creative, we would look at analytics across the entire average. What we're doing today is starting to do more segmentation so that we can curate and tailor the message and creative to the right audience member. So the law of averages will only get you so far. You really have to sharpen your pencil and start sub-segmenting once you get to that point of diminishing returns.
Last question.
Thank you. Hi, I'm Chris at a local credit union out here on Long Island. Similar to you, Gen Z is a huge audience for us, trying to get younger, and credit card acquisition is a great tool for us. But one thing I found, it's one thing to get them to apply. Are they going to be approved? Where a certain channel might bring in 500 applications at a lower percentage. So how much are you working with the team behind the scenes, talking about approval rates, making sure this is being successful, and in terms of being adjustable? You know, if we see delinquencies rising or balances rising too high, and then adjusting your marketing that way as well. Thank you.
Oh my gosh, excellent question. This is honestly at the heart of our strategy for Credit Karma. What makes us differentiated in the financial marketplace, looking for credit cards, personal loans, is our approval certainty. So once you log into Credit Karma, we are stack ranking. It's a model-driven stack ranked marketplace with the highest probability for approval and conversion at the top. So we're only showing our members the offers they are most likely to be approved for and take out. So once you're logged into Credit Karma, amazing. This is like huge teams focused on this. Our approval rate on credit cards for Credit Karma members who shop with us is 50% higher than the average in the US. Like massive, it's huge. And what a great experience for a consumer. Now you're talking about paid search. This is completely unqualified traffic. So this is really hard. Our paid search strategy has shifted. Like you think about the conversion rate optimization you can do on a paid search landing page. You can change the headline. You can change the look and feel. What we found was the most impactful was reordering the cards. And what tends to bubble to the top are the broader underwriting starter cards. And this is a bit in overlap because Credit Karma has a little bit more of a subprime brand where credit building is kind of, that's what people think of when they think of Credit Karma. We're trying to change that. So we've stack ranked our cards based on the traffic we're getting from search, and it's still not perfect. What we started to do was test, can we force a login? Can we put the friction of a login to get someone to log into Credit Karma? Will they get a better offer, and will our conversion rate go up? The answer was sometimes. And so then I forced my team back in the day to like, hey, can you build me some technology that uses cookies to identify if this person's a Credit Karma member and give them dynamic offers without a login? That was a big unlock. So we're constantly thinking about approval certainty and only showing the best offer to the right member. But it's tough. Yeah, and then actually from a risk perspective, for all the lending platforms out there, for us as an affiliate platform on the B2B side, we're a really enticing channel because our traffic's all qualified. We're not doing broad reach campaigns and sending you lots of decline traffic. Everyone that's going to apply through a logged in Credit Karma experience, we know who they are. We know that they have a social security number, like we know their credit profile, and that you've told us you're very likely to approve them.
Wow. Well, my understanding, Taisha, is we are the last thing standing before lunch, which is now. And so thank you so much. I still have a million questions for you. And I appreciate your time on this one.
Hey,
This
this
is
was
great.
super fun.
And
Thank you.
education.
So we have 1 hour